Welcome everyone to Vested Interest. This is Shane back again for their stock pick of the day video. It is October 3rd. Today we are going to take a look at McCormick. It is a company that provides spices out of the consumer staple sector, and the race for spices has been going on as long as we have been a country, even before that. That is how, if you recall, Columbus discovered America, which is hard to discover if you already have people living here, but we'll forego that. He was looking for a trade route or a faster trade route to Asia to be able to trade in spices. So it's been around for thousands of years. People need it, people use it, people are going to continue to use it. Let's see if this company that focuses on spices is presenting any value right now. Let's jump right in. If you want to know more about this company, check them out at www.mccormick.com. That is www.mccormick.com. That is their homepage where I pull this information from. And as you can see, here are their brands, and you probably know a lot of these brands and have them in your cupboards, right? McCormick, Lawry's, French's, Ducros, Red Hot, Frank's Red Hot sauce, Old Bay, Asia, Stubbs. I like Stubbs barbecue sauce. Thai Kitchen, Margallo, a lot of the different McCormick brands, Billy B, Clubhouse. I mean, a lot of these I recognize right off the bat. El Guapo, Gourmet Gardens, Cholula. Buddy of mine, whenever I was in the military, loved Cholula. So Simply Asia, Old Bay. I mean, you probably, again, recognize a lot of these brands here and may have some of them in your cupboards, I'm sure. McCormick is a global leader in flavor, operating in two segments across 170 countries and territories with compelling offerings for every retail and customer strategy. Our iconic brands have leading share positions in many of our markets. So another one that is spread out across 170 different countries. So if we are experiencing a pullback or recession in one area, hopefully another one is doing well. And with that spread out, that should keep them in business for years and decades to come, unless 170 companies or 170 countries, everyone in those countries decides to stop cooking with spices, which I highly doubt. Let's keep on going here. They were down 8.46%. That is why we were looking at them. Huge drop on the day. This would be a huge drop for a year, so let alone for the day. We are talking about McCormick and Company Incorporated, ticker MKC, out of the consumer staple sector. Closed the day out at $68.40. 52-week range as low as $66.60, as high as $94.39. So they are definitely closer to their 52-week low than they are their 52-week high. Average volume 1.1 billion. Today's was 7.4, and it was just a sell-off overall. Then they leveled out a bit, but a big sell-off in the morning and then leveled out throughout the day. 18.631 billion market cap. Beta of 0.58, so they are usually much less volatile than the overall market, even though you can see that volatility today. Now, this is where things get a little wonky. Price to earnings ratio, PE ratio, $26.72 per share. That is very high for a company like this. I don't think they are growing fast enough to justify that price to earnings ratio. EPS is decent at $2.56 per share. Earnings date is October 3rd, so that was today. Excuse me. And I would be willing to bet there was something in this earnings report that had them dropping like a rock today. Forward dividend is $1.56. They are a quarterly payer, so divide by 4, but we will see that here in a little bit. Decent yield at 2.06%. Ex-dividend date, October 6th. So if you were to buy them up to October 5th, you would be in line for their next dividend payout. And a one-year target estimate, at least according to Yahoo Finance, of $88.25. Now we are going to look at dividend yield theory. To do that, you go into statistics here, go down to dividends and splits, look at their 5-year dividend average, 1.55. Compare it to today's 2.06, or over here, forward annual dividend yield, that is 2.06, same number. And since it is higher, that speaks to some potential undervaluation. This is one of those cases where I do not agree with that. I think they are still overvalued and need to come down some more. Much like General Mills, they need to set a new 52-week low, right? That is my opinion. They do have a low payout ratio, 58, not super low, but under the 75% that I look at, $58.69 or 58.69%. And their ex-dividend date, like I said, October 6th, they're going to pay out on October 24th. Now, free cash flow, we want to look into the financials. A lot of good information here: balance sheet, income statement, debt to equity ratios, revenue. You want to look at all that. Is the revenue growing over time? Are they paying down their debt? Free cash flow is another one we want to look at. We want growing dividends over time. To have growing dividends over time, you want growing free cash flow, because that is what dividends are paid out of. Went back to 2019. You can see here 773 million free cash flow. 2020 jump up to 816 million. 2021 big drop down to 550 million. 2022 even bigger drop down to 389 million. Looks like they've recovered a bit this year. To date, 612 million. So overall, from 2019, depending on where they end the year, over the last few years anyway, they have been declining. And again, depending on where they end the year, decline in free cash flow. So that is not good to see, even though they are repurchasing some of their own shares, which is nice to see. The share repurchase doesn't really account for some of these drops. As you can see here, from 816 million, and they repurchased 470,300 of their own shares. That share repurchase was down as well as their free cash flow in 2021. So that does not account for that drop, nor does it account for in 2022 either. So even though sometimes the repurchase of stock will account for some of that free cash flow drop, this time I'm not seeing it. Maybe here in 2023, but again, I'd have to see where they end the year to see if maybe they've rebounded altogether. Now, I always recommend more than one source, so another one that I like is stockanalysis.com. Now, you can pick any sources that you want. Just make sure you're looking at more than one so that you can back check the information you are getting is accurate and make sure the updates are coming in a timely manner. They have 11 stock analysts that have taken a look at this. They call it a consensus hold, and I would tend to agree on this one. Like I said, I would look for a new 52-week low on this one. With everything dropping like it's dropping, this would be a perfect candidate for a pullback here. I would like this price to earnings ratio, PE ratio, back in the teens, 16 or under, 18 or under. Maybe I'd go as high as 18, but for a company as big as this one that's already pretty well established, you don't want to pay a real high price to earnings ratio. They are not growing that fast. Now, they have a low estimate of $66, which would be a 3.51% decrease from where it currently sits, and I believe that would be a new 52-week low. So again, one I would look for a new 52-week low on. Average estimate of $82.73, that would be a 20.95% increase from where it currently sits, and a high estimate of $100, that would be a 46.2% increase from where it currently sits. Now, I like to go into statistics here and look at return on equity and return on invested capital. I like 10% or better here, and it does beat those numbers. Return on equity, 13.80%. I was surprised by that, so that's above the 10% I look for. Return on invested capital, 16.60%. So again, was pretty surprised by these numbers. That is very good for a company like this. And EPS estimate is 5.47%. That is above the 5% that I look for. Overall, not bad metrics. Free cash flow a little wonky, and the valuation, again, is a little high in my opinion. I have not done a discounted cash flow analysis on this one. I would have to do that. I would anticipate this probably being down in the 50s as far as where it should be for value, but that would be just me shooting from the hip. So again, I would look for more of a pullback on this one. Revenue forecasted growth at 4.02%. So all the numbers except for the stock price really look decent on this one. Let's look at the dividend growth over time. So again, low payout ratio, under the 75% that I look for, 60.23%. Dividend growth of 5.41. Decent dividend growth here. They do pay out in January, April, July, October. So a January payer, not a lot of them out there. So I like that, actually. We went back and looked at 2020, was paying 31 cents in October of 2020. They jumped it up to 34 cents in December of 2020. They jumped it up again December 30th, 2021 to 37 cents. Jumped it up again December 22nd to 39 cents. So if they were going to continue this trend, look for a increase in the payout ratio in December here. Again, decent dividend growth at 5.41%. So overall, not a bad company. I do like the company. I do own their products in my cupboard. I just don't like the price per share right now. This is the vested interest stock screener. This is how I set up the videos, as well as how I look at a company on a high level to see if I'm interested at all. It is an initial screener, guys. It is not, I'm not saying if it meets these criteria, I'm buying it. It is just an initial screener for me to weed out companies that I'm interested in doing more of a deep dive. And then I really get into the financials, look at the revenue, look at the balance sheet, look at the income statement. I do a discounted cash flow analysis on it, see what I'm willing to pay for it. But overall, this is a way I screen stocks on a high level to see if I'm even interested in going that deep or going any further. Understand the business, growing free cash flow the last 5 years and expected into the future, growing dividend over time. Dividend payout ratio of 75% or less does not apply to REITs or BDCs. These companies are required by law to pay out more than 75% of their free cash flow to get the beneficial tax breaks that they get. Check valuation based on dividend yield theory. That's what we did. Buy below current cost basis or within 15% of the 52-week low. So I look for a company that's within 15% of its 52-week low or right up against it, or in some cases setting a new 52-week low. General Mills, for example, is one that I'm interested in that is setting a new 52-week low right now. Return on invested capital and return on equity equal to or greater than its industry or 10% or plus, and earnings per share growth greater than the industry or 5% plus growth. For financial companies, I throw in price to book. A 1 is fair value. Anything under 1 for a financial company like a bank is below value. Must meet 5 of 8 to be investable, so that's for me to do more of a deep dive. And if it's a financial company, it must meet 6 of 9. You can use this screener, you can adjust it, modify it. Make sure you are doing your own due diligence and not just buying something or looking at stocks that I'm looking at. I'm just this guy on YouTube, right? I grew up in a double wide trailer. I don't necessarily know any more than you do. I've learned all this along the way in my investing. And if you look at my portfolio right now, like a lot of people, I am down. So I am not some investing guru who's beating the market by 100% or whatever. So again, tweak this however you want. This just gives you an idea of how I am looking at companies and how I am setting up the videos to see if I am seeing any value in these companies that I look at. Well, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us here in the vested interest community. Join us on this journey to financial freedom, building a community of like-minded dividend growth investors so we can share our experiences, share stocks like this that we may be watching, that we may be buying, that we may be avoiding altogether. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd like me to cover, like McCormick, drop it down in the comment section down below and let me know what you think of McCormick. Is it in your portfolio? Do you have any of their brands in your cupboards? Drop a comment. Let me know what you think. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm going to share my opinion and investing unity for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.